welcome to Masters of Real Estate. My name is Mathew Owens, and today we have a special guest for you guys, Gina Tang, that actually helps and works on high-end housing here in the Southern California market and has been doing that since 2010. Also works out of state with different rentals and has a different philosophy and different focus than a lot of the traditional real estate investors working in the high-end housing, seeing a different perspective than a lot of people. And she really has, we were just talking and she was just mentioning to me about the importance of location and, the demographics of an area and all the different economic indicators that go into your investment decisions with regard to investing in real estate. So Gina, thanks so much for joining us. I really appreciate it. I would, love to get your background and experience and what kind of led you to real estate in the first place.
Thank you. Thank you for allowing me to be part of the show. My name is Gina Tang. I am a Chinese American immigrant. My family and I we're from Taiwan, and also we came by way of China. So none of us were born here in the United States. So my parents, the classic, typical Chinese American immigrants, they came to the United States and they started owning small businesses. And every chance they got, they bought real estate. So they made a lot of money through real estate. So when I was straight out of college, I was 22, 23 years old, they taught me how to buy real estate. I was 22, 23, and I was a landlord. My roommate, I bought my very first two-bedroom condo in Long Beach. My roommate was my very first tenant. I had no idea what the heck I was doing. I had no clue. She clogged up my shower with her long blonde hair. She was a student from Cal State Long Beach, and I had no idea what to do. I raced to Home Depot, and they taught me the whole Drano thing. So in the back of the Drano bottle, it tells you that you're supposed to leave it in there for 15 minutes. Well, the guy told me you're supposed to leave it there for an hour. And I'm so glad he did, because that was my very first attempt at being a maintenance person. So I learned how to maintain properties. Yeah. So ever since then, I've been buying real estate out of state. 2010, I got my real estate broker license. I started working for luxury home builders and here in Los Angeles. And then I also worked in downtown Los Angeles. I was director of sales there. I was selling really high-end, very expensive high-end luxury condos. So altogether, I've sold a little bit over 200 very expensive single-family homes as well as high-rise condos. And in 2020, when COVID hit California, I started to fix and flip high-end homes. So that's all I do now. That's all I do is fix and flip luxury high-end homes. So I went from, and also the money I made from fixing and flipping high-end homes, I turned that into BRRRs out of state. So all my rentals, I buy the BRRR out of state. And I'm really a stickler when it comes to location. I think it's from being in the high-end market, and I see the benefits of being very, very location driven.
I agree. I think, looking at that perspective of things, and for those of you guys that don't know, the BRR method that she's talking about is buy, renovate, rent, refinance, and repeat. And it's basically the idea is to buy something under market value, renovate it, increase the value, and be in it for low enough of a cost to be able to refinance that and pull all your money back out of it, or the majority of your money back out if possible, and then hold that as a long-term rental long-term. So you're really not in it for a whole lot, which is a great strategy to utilize. A little harder to do right at this moment because of financing problems, lack of inventory problems. You got to find the right deals. We still see a lot of people getting those done as well in our lending arm, where we see people getting them for 50 cents on the dollar and being in them for 75% all in after rehab and everything. So really great strategy to utilize. And I couldn't agree with you more with regard to the location aspect of things. Some of the main benefits, obviously the higher end market that you play in here in Southern California, you're dealing with, properties where the buyers are less susceptible to economic volatility themselves and their own financial situations. And so, I would assume that you have less volatility in the pricing in those types of assets, unless you're dealing with the multi-millions where, maybe on a percentage basis, it's it's a small percentage, but that seems like a big dollar figure, when you talk about, a $10 million house or something like that, or in those types of ranges, right? What are the ranges that you really focus on, and what are you seeing with regard to the economics? Like, have you seen a slowdown? Have you seen, things that are, still going up in price right now in those areas? And what are the specific areas that you do focus on?
California has the highest percentage of wealthy people in the United States, and that goes from Northern and Southern California. So if you want to work with
Okay.
high-end buyers and so far as inventory and so far as buyers and sellers, California is the place to be. So this is why this is the best market for me right now. I I focus on higher end homes up to $5 million, meaning that I buy them for $2 million and then I renovate it and I flip it for less than $5 million. And I try to stay away from the city of Los Angeles because right now there's a mansion tax. And there's other areas of LA County that don't necessarily fall into the city of Los Angeles, like for instance South Bay. The entire South Bay area is not part of the city of Los Angeles. So right now I have a fixture that's going on in Rolling Hills Estates. So I buy them for up to $2 million, and then I put the renovation in and I can flip it for three, four, $5 million. And it's a very nice profit margin. And you're absolutely right. In the high-end market, there tend to be more cash buyers, especially in the market segment that's less than $10 million. There tends to be more cash buyers, and there are more international buyers. So these people are ready to put their money into some kind of a real estate here when they get here. And I have found that when it's less than $10 million, the house tends to sell a little bit quicker than if they were maybe 11 million, 12 million, 15, $20 million. So I try to stay within that. I call it the sweet spot. So, and
Nice.
also, yeah, I call it sweet spot. And also, I work with a demographic that I like to refer to as the working rich, which I have been working with over the last, gosh, since 2010. These people
Okay.
work very hard to get out of middle class. So I call them the working rich. They work extremely hard to get out of middle class, and they still work very hard. These are CEOs, doctors, lawyers, even some politicians or business owners, and they want to kind of keep up with the Joneses because over 20 million, 30 million, those are the Joneses. So the below
Right.
20 million, these people want to stay up with the Joneses. So I have found in this demographic of people, they normally don't nickel and dime me when I put things like $30 light bulbs, when I put things like high-end technology into the house. They love high-end technology. These people are well
Right.
educated, well traveled, they know a lot about technology. So a lot of times they have very high expectations. So I have to know my appliances. I have to know the different brands. I have to know all my different brands. I have to know all my different cabinet makes and distributors and all the finishes because they will go through that house like a fine-tooth comb. And also with customers that spend over $3 million on a house, they have very, very high expectations. So that's
Right.
the demographic I work with. And also I have found that this demographic of people, they're usually the largest buyer segment, and they actually will buy houses a lot quicker than like let's say a $15 million house or $20 million house. So I have found that I like working with this demographic segment. I call them the working rich. They are actually even like people like athletes because they have to work really, really hard. The athletes, like even some celebrities. The over the 20 million, $40 million homes, I call them asset people because these people don't really work for a living. Their assets work for them. They are the Joneses.
Right.
Yeah, it's a whole different demographic. I have worked with them, but not as much. It's a whole. They have 12 houses throughout the world. This is just one of the many. They have a whole different demeanor. They travel around by helicopter. It's just a whole different market segment.
And what are you seeing right now with regard to the economics in that type of market range? With the interest rate change and things like that occurred, but also the big lack of inventory that occurred right now. And I would assume in that market in particular, there's you have a segment of the markets that you're working in and focused on, and your primary farm areas because that's a very unique. 2 million to $5 million range. There's a lot that's under the 2 million, and I guess a lot less that's above that, but depends on
Yeah.
that specific location you're talking about. Rolling Hills is obviously a great area to be investing in, and I think that's a prime location that isn't going to have major economic volatility. But what are you seeing when the interest rate change occurred and stuff like that? Are you still seeing stable prices, or still an uptick in pricing right now, even given what we're seeing in the overall kind of I'd say weakening of the overall economy as a whole?
Um, from what I understand is that there has been a little bit of softening insofar as the luxury home prices, but insofar as buyer
Okay.
demand is still there. And I have found that in the new home construction area, especially in the high-end luxury home builders, there has not been a slowdown. And the interest rates, yes, it
Okay.
has impacted some, but it doesn't impact as many as you think, because in the high-end market area, there's a lot of cash buyers. So it's a
Makes
whole
sense.
different market.
Okay.
Yeah. Yeah, it's a whole, and also this is not their only house. This is their fourth, fifth, maybe their third. So it's a whole different kind of market. Yeah. And I have not seen the volatility and the sensitivity to interest rates in this market that I have seen in other markets. There's some price reduction, but not as heavy.
It just goes to show you that, I think a lot of real estate investors don't understand this piece is who's your target buyer in the first place, and really focusing on what their needs are and dialing in on who that avatar is, and who you're focused on, and who your buyer is key. Like knowing everything about them and understanding what they want in general. And like you seem to have a very good grasp of that. And I think a lot of investors don't realize that's very, very important when you're mitigating risk on your flip, because no matter what happens in the economy, yeah, you could have short-term liquidity issues that could cause a problem, of course, but if you have a majority cash buyers, or a big chunk of them being cash buyers in that space, or just a bigger percentage, it mitigates that risk of financing and stuff like that, of course, quite a bit. And they're buying it because they want that house, because they want to keep up with the Joneses, like you said, and be able to get all the bells and whistles to impress their friends, and their COOs and CEOs in their head, and doctors in their head, and they need to make sure that they have the right house for them, right? So it's a really interesting understanding of know your client, know who your customer is before you go into any flip. Who's that buyer going to be, and what are they going to want? Because you could under renovate or over renovate a property in a particular area by not understanding that up front, thinking that, hey, these extra things are going to give me way more bang than my buck, but they may not, depending on who your buyer is at the end of the day. I would assume, like you're saying, you have to have high-end tech and high-end materials in these types of properties. And I would, how do you keep up on all the different things that are out there that you can include in the properties now? Like there's all new kinds of new technology every single year. Do you go to these like trade shows, or have designers that help you with this stuff when you're doing it?
Absolutely. Absolutely. I'm at an open house almost every other weekend in some high-end area. I'm always out in Beverly Hills, Bel Air, driving around, just looking at all the different technology out there. And I love looking at flips in Manhattan Beach, Venice Beach. I love going Malibu, Santa Monica, because I have found a lot of them integrate a lot of new technology. And they also, a lot of them are tear downs. They'll tear down a particular house and they'll bring it down to the studs and they'll rebuild it again. I absolutely do. And I also
Okay.
go to different distributors and vendors, and I also look at what's out there as well. And I love it. I just love it.
I think that market knowledge is really, really important on your flip, no matter what area you're in, of course, higher end or lower end, knowing, what vendors to go to, what design to follow, because there's so many changes in the market. 10 years ago, it's a completely different look and feel than a newly renovated house now. And so, especially with technology changing the game, like it's almost like your house is going to be outdated in 3 years, or a year even, in some cases.
Yeah.
And so having the latest and greatest technology really adds a lot of mental value for the buyer of that house in the first place. And being able to focus on that, I think, would be, really important. Now, you also said you go out and you do Burr method refinance or Burr method acquisitions out of state in these other areas, and you do your fix and flips in California. I can see why the dollar figures profitability there on those fix and flips are really awesome. And what do you focus on out of state? state? Are these rental properties that you're buying out of state and holding for cash flow? If so, like what areas and what price points and what markets are you focused on?
I do focus on the red states, not necessarily because of the politics, because I have found them to be more landlord friendly. And when I go to the red
Hmm.
states, I look for C plus, B minus neighborhoods. I don't go into the high end areas like I do here in LA, because I do
Okay.
want to have some, yeah, because it has to make sense for it to be VRRR. Yeah, I don't flip
The
out of
rent to
state. I
price
actually buy.
ratio really matters.
The reason why I look for C plus B minus is because once again, the demographics. Those demographics of people are going to be usually two income families, and they're going to be some kind of professional parents. And I have found that I usually buy single family homes in those areas and also some multi units. And I have found that that demographics of people tend to have children. And so those, because they have dual income and they're a stable family, and with children comes more
Hmm.
stability, tend to take care of the house a little bit better. So and also I can charge higher
They
rents
stay there
because,
longer.
yeah, and I can also charge higher rents, and also there's better appreciation in those areas. If I were to buy a little bit more lower level, like a C minus, D plus, maybe a D minus area, sure, the cash flow is good, but I don't get the appreciation that I normally would get, and also I can't charge higher rents. So that's the reason why. So I am a really big stickler when it comes to location, because that location will drive your rental price, it'll drive your appreciation, it'll also drive the demographics of people that are going to buy or rent your house, and it makes such a big difference.
I really like to hold properties that have, $1,500 to $2,000 plus in rents out of state, because one, because of the repairs and things like that, costs the same on a low end house as far as a middle market type house or a C or B type house, and then the higher end you just get a lower rent to price ratio type issue there, what makes it not cash flow as much. It's harder to refinance and pull all the money out, and at that you need to have a bigger discount because you need to leverage less so that it still cash flows in those higher end ones. And the lower end ones, you find that, hey, yes, like I said, those repairs cost the same and the rents don't go as far as to cover some of those things sometimes. And then the tenant base tends to not take care of the property as well. They are more susceptible to economic volatility because, if you think about inflation that just occurred massively and is still occurring, if like my food prices or someone's food prices that lives in Manhattan Beach, for example, or something goes up by 25% or goes from $1,000 a month to $1,500 a month or whatever it is, that may not be like the end all be all of my financial situation or someone's that makes a good income's financial situation. Someone that's barely getting by, their stuff goes up by $500. That's going to be a really big detriment to them on a monthly basis, to where if their incomes don't keep up, they're going to be really struggling on an affordability standpoint, not including the mortgage or the rental amount and things like that. And so you want to be able to make sure people are making three times the rent. You want to be able to make sure that they are, financially stable, because the thing that costs you the most money in rentals is, of course, repairs and turnovers and things like that occur. Turnovers and bad debts are the two biggest, issue that you want to avoid at all costs. And then, of course, making sure all your capex is backed up and you are putting money aside for HVAC systems, for roofs, for plumbing, electrical, appliances, all the things that break over a period of time that look like a big, scary expense when they happen. But if you plan for it, you're in a much better position. A lot of landlords don't do that, and I think it's crazy important. So, have you found these same type of things when you were investing in the past?
Oh yeah, definitely. I mean, this maintenance thing is just an ongoing thing. However, I have found
Right.
that you compare my stories to maybe somebody who owns properties like in the C minus areas. It's different stories because of different demographics of people. They're just a little bit more drama in the little bit more lower end areas. I'm just hearing it. And I'm not saying there's no drama in my segment. There is, because I had a tenant once that decided to go buy a Mercedes to keep up with the Joneses in my one of my rentals. And she didn't pay her rent for like 2 months because she was late on her payment because she was trying to keep up with the Joneses. because apparently the neighborhood that I bought in was like a really nice area. And so, I mean, not like a Beverly Hills, but just like a nicer area in that part of Central Florida. So yeah, so I mean,
Yeah.
I'm not completely immune to drama. Yes,
There's
the keeping up with Joneses people have their dramas too. Trust me. So I'm just saying
when
these
you're dealing when you're dealing with
yeah, go
rental
ahead.
properties, there's always issues. We used to own a property management company, and then I sold it because I was going, this is just here, deal with problems. That's all it really was, right? And no matter where you're at, there's those issues. And I think you get a lot more affordability issues in the lower end stuff. You're going to
Yeah,
get death, divorce, bankruptcy, problems in every segment of the community, whether it's higher end or lower end. There's going to be life problems that come up across the board that occur, and you can't avoid those things. Of course, you can try to mitigate the risk as best you can, but it's all part of this, and that's why I highly recommend having an outside property manager in place that handles these issues. Because if you're trying to be a passive investor, it's hard to you really don't want to be managing the day to day of these different rentals. It's not worth the time to do that. That extra 8 to 10% or 7 to 10% management fee is not worth it to deal with all that stuff. You still have to manage the managers, which a lot of people don't realize. And I think having understanding what is a good manager and vetting your pet property manager up front is one of the most important things you can do. And getting a referral to multiple managers. We do background checks, criminal checks. We go through and call different investors. We look at their accounting statements. We ask them what their procedures are with regard to, leasing procedures, communication procedures, accounting procedures, tenanting, all this stuff that it's like the different aspects of running a business that every company could potentially have an issue with. And I found that a lot of them are good at like 90% of the things, and then there's always something that you have to work with them on. And when you're
yeah,
dealing with property managers, a lot of times they're out in the field. Sometimes they don't answer your emails like immediately because they're out in the field all the time handling problems. You have the one man bands out there, and then you have the teams that have systems in place. And
yeah,
knowing which ones you're going to go with are really, really important, because with expansion comes inefficiency, and sometimes they're great for a while, and then they start sucking really bad because all of a sudden they took on way too many units or something happened with their company, right? And so
yeah,
I always like to have multiple backups of property managers in place as just in case people, if something blows up or something like that, because the managers will make or break your investment. And and I say you, meaning investors as a whole, shouldn't go through and necessarily manage your own units if you're doing it efficiently and have other income that you can make in other ways. And you'll probably be less efficient than a manager that has experience doing nothing but that.
yeah,
So
yeah,
unless you only own a couple of rentals and you're in the market and you're just a mom and pop, maybe you can pay close attention to it if you don't have anything else to do. Then fine.
yeah. I
But
absolutely agree. I absolutely agree.
I think you learning those lessons in the beginning with your roommate on those repairs and service, those are the repairs you had to do, is a great segue into understanding the things that happen on rental properties. You learn those things over a period of time, and after a while, you're going, that $1,000 expense or that $5,000 expense is like, oh my God, that's like the end of my cash flow. This doesn't work. This is the scariest thing on the planet. And then after a while, you're like, yeah, okay, next. This is what you do. Go
Yeah,
do it, and handle it.
yeah,
And you stop reacting emotionally and realize that's part of the process, and make sure you have enough reserves for your assets to make that work long term. There's so many mom and pops, including my own family, that they came to me a few times saying these buildings are not performing right. We have all these repairs. And I'm like, wait a minute. You had reserves for CapEx, but you're seeing it all happen at the same time because these CapEx things are coming due now, the plumbing and electrical and the roof and, that kind of stuff. And of course, it looks like the property's not performing and cash flowing. But if you average those things out and those expenses over the long run, you'll see what that average cash on cash return is on the deal. And it really makes a lot of sense if you put it in that perspective that way, because a lot of people make the wrong financial decision because they think all these problems are happening at the same time, all because they mentally didn't plan for them.
yeah. I can honestly say that, since I bought my first rental property in Long Beach, like I said, when I was 22, 23 years old, I have been a landlord longer than I could ever imagine. It's probably been my longest career. And I think, if you were around during the 80s and 90s and the year 2000, there was a lot of right sizing and restructuring of companies here in California. So you were
Hmm.
around. A lot of people, so I have been downsized, right sized so many times. But being a landlord has been my longest career. It's been like, it has the longest longevity. And honestly, I've never laid myself off because I can't lay anybody off because my
It,
tenants, they rely on me, my property manager rely on me, I got somebody in my house. So I mean, yeah, it's been my longest career, and I've always had to come through for them, right? As well as you know, right? Because somebody's toilet's got to get fixed, something's got to happen, and I'm really
right.
glad I did, to be honest with you, because I've held on to some of these properties for a really, really, really long time, and I've been able to reap the benefits of it. So, if you were to ask me today what I would do differently if I were to go back to my younger self, is to start earlier. I know I started when I was really young. I started when I was 22, 23. That is actually a really good age to start. So if there's anything that I would recommend to people is to start like right out of college, because you have just enough knowledge to understand about the world, about how business works. At the same time, you have that youth and energy to really kind of take on something like this. And I
Right.
also think I would recommend, and this is particularly because if you invest in single family homes, is that I had to unload some single family homes during the recession, during '08 and '09. And I can't tell you how much I regret that I did that. At that time, some of us were bleeding because we had tenants that didn't have jobs. So because they didn't work, we didn't have the money to pay for some of these mortgages. So I had to short sell some of these properties. I had to short sell three of them. I look back now, I wish I had borrowed the money from anybody, somebody, to keep those properties,
Just to hold
because
them.
there's a shortage of single family homes right now. I can't go back and buy those homes that I sold at the prices that I
Right.
paid back then. Today, now it's like, I bought it back then like 100 something, whatever thousand. These were prime rental areas of Tennessee and Alabama and Florida.
Right.
These are like the highly targeted rental property, rental areas, right? And you know what? Today they're worth like $400,000. I cannot buy back those properties at the prices that I held, I bought them. So if there's anything I wish I could tell myself is when things get tough, do not, especially single family homes, because there's such a severe shortage right now. Please hold on to them.
I I agree.
Please, please
I
hold.
just did a YouTube video specifically on this topic where I was referring to, I quit my CPA firm job to go into real estate in 2006, and so I was a real estate genius for about a year and a half before I got my ass handed to me and lost everything in the market crash. At the same time, I then went on to continue to flip and continue to push forward, and we've sold over 1,000 houses now. And I look back and I did the math, and every single one of them would have went up by over $50,000, maybe even $100,000 for those, and that would be $50 million minimum on if I was able to hold all those. And it was a mentality switch from I need to flip to make income because I have to live, right? Versus wow, I could have just put a fund together or something and held them and just raised money from investors to continue to hold over a period of time, and at least made half of that money myself over that period of time and given the other half to my investors. It was a mentality switch of what should I be doing, because you can build in a salary into those types of those things and pay for yourself with an assets under management fee and those holds as well. And so knowing what I know now and the ability to, bring in investor capital for these deals, it would have been a much better focus instead of focusing on selling them all to focus on just raising money from investors to put against these to buy them. Now, it might have been a hard sell in 2008 to raise money to buy real estate, because everybody is scared at that time of real estate, and at the same time, being able to buy at the bottom of that market, like we were buying properties in Tennessee. I bought a house for literally $30,000 with $3,000 down with a $3,000 repair credit that needed about 7 grand worth of work. That immediately afterwards was worth 100, and then went up to like $250,000 after that over the next like 5-10 years. And I was like, it's just insane. Like And I think that one at that time rented for $900 a month when I bought it for 30 grand and got seller financing at that time. Like some of the deals that you're just like, but that back then too, to be fair, a full renovation might cost 15 to 25,000 versus like way more now. So you look at the numbers differences, and it's crazy even on the rehab side what you could have been into these things for. And there's
Yeah,
still great deals out there, but you're not seeing that type of deal unless you are really focused on a massive marketing campaign and you're cherry picking like crazy, to get those types of crazy deals. But you can work them.
yeah,
There are people that will move properties to you and you'll get big discounts. It's just that kind of level discount. When there's a lot of distress, that's when you make even more money because that, even if there's a 10% drop in prices, which would be like a crash. That's like a 2008 crash that occurs with, when that in 2008, it went down like 6%, 5%, sometimes 4% a year, depending on the market. There was an initial liquidity drop that occurred when there was no liquidity in the market because of the banking crisis that occurred at that time too. And then it was a slow, steady decline for like a 6-year period down to like 2012, basically. And so when you look at that, cycle and you're saying, hey, if I'm in and out of this in 12 months and my property drops by 5%, but I go pick up the property for a 30% less than what I would have normally paid for it in an upcycle market, your margin is way bigger. You might have some risk of time that you need to consider, in a dropping market, but the pricing you can get is like people are afraid, so they will let it go for cheaper. So
yeah.
really interesting. It's exciting and sad at the same time when there's a market collapse or a problem that occurs. So
Yeah. Yeah, I definitely agree. If I were to tell myself or recommend something to myself, my younger self, I would definitely say start sooner, start as young as you can. You don't need a college degree to do this. And I'm not discouraging college education because I have an MBA. I'm just saying, you can jump in. And then the other thing is there's a lot of these gurus out there saying you don't need money to start real estate. You do. You do need to, you do. It may not be your money, but it could be your parents' money,
right,
your uncle, your aunt, somebody. Just get somebody to help you.
somebody,
My
right,
parents first helped me with the down payment of that 2-bedroom condo. They didn't buy it from me. They helped me with the down payment.
nice.
And that's how I got started. And then I just parlayed the equity from that house to the next one, the next one. So, and then
That's awesome.
getting back to what you were saying, Matthew, there's also, you can refinance the equity of your house and then that money is tax free. That's another way to also look at it. But, look at it. So if you were to keep that renovation, once you renovate it, you strip the equity, right? And then you can also keep that. That money's tax free. So that's another way to make money from real estate as well. And I wish I would have kept those houses. I wish I had kept those. So no matter what happens, boys and girls, no matter what happens, doesn't matter how bad the economy gets, please do not sell your real estate. Because right now there's a major shortage of single family homes. It's going to take forever. It's going to
Right.
take builders
And
forever to
it's
get.
getting worse. It's
Yeah,
getting
it's getting
worse too.
worse.
So and
It's
I
worse.
think if they drop rates, I see more demand coming. Some people try to say that if they drop rates, then more people will then sell their houses because the difference between their current, call it 4% rate, and if it drops to 6 and a 6% rate versus 7 is a little less, and so it entices people to put their houses on the market, but they're still moving somewhere, so you're still creating another buyer, an equal buyer out of a seller over here as well, and you still have more from the demographic aspect of things. It looks like there's going to be even more demand in the future, more population growth and things like that here in the U.S. And so we'll see what happens, but I think that there's going to be more of a shortage. Builders are having a hard time right now as well, and so things are on the market a little longer from builders' perspective versus, and it depends on the market. Again, in a higher end market, it might go a lot faster. So I think there is risk out there right now in the general overall economy, but at the end of the day, I don't see how a market crash is possible with the lack of inventory we're seeing right now. Affordability is horrible, at the moment, comparatively, historically, but I don't know that that's going to change anytime soon. Yeah, interest rates may drop a little bit, but that's going to spew more demand, which is going to spew more price increases as well, potentially.
Yeah.
So yeah, there might be some. I think wages need to keep up with inflation, and that's something we really got to pay attention to determine what may happen with real estate prices. Do you agree or
Yeah.
disagree, or what are you seeing out there?
I absolutely agree. Another thing I also want to add, this is from a real estate broker perspective and also from flipping high-end homes and just homes in general. Homes that are improved in general, whether it's a flip or whether it's new construction, tends to get bought quicker. And homes
Hmm.
that are just not improved, homes are just been they kind of have a real data look. They just kind of sit on the market a little bit longer. So when you talk to people and they tell you, oh my God, my house been sitting on the market forever, you need to ask them, tell me, tell me a little bit about your house. And you'll find 9 times out of 10, it looks dated. It looks old. And because I recently was involved in helping a friend sell her parents' house. She inherited a house from her parents that recently passed away. It's in Pasadena, right by the Rose Bowl. Beautiful house, single story. And I went to her house and I recommended to her to spend at least $20,000, $20,000 to update it. She updated just some key areas, not the whole thing. Just put some key areas where when the people come in during an open house, there's that wow factor. There's that just that high impact. It just pops like when you walk in. That house
Right.
on the weekend of her open house, she got 10 offers, and it was sold above asking
That's
price. And this
insane.
was just 3 months ago, and yeah, 2 3 months ago, and she sold it for like 2.7, 2.8. So it's not it's it and she spent the money though. She spent the money to pay,
Yeah.
you pay, new like
It shows you, it goes to show you significantly how important it is to ask these types of questions about what's happening, because you can't just go through and say, hey, I'm seeing, houses out there that are dropping or sitting for a little while and things like that, when you have different levels of finishes, you have different problems with those properties. People can't see the vision of a house sometimes that is not renovated yet, or maybe just plain Jane type type look to it, right? And so I think understanding those factors is really, really key. And also seasonality too. A lot of people say, oh, this is changing in the market, there's things that are happening, but there's always things that are happening. There's always changes depending on the seasons of the market. You can't just go say all of a sudden, hey, we're in a hot market right now. Wow, things are going crazy up. Or we're in the winter market and things are, dead. That's always the case, So maybe not as much in California, more than the Midwest and the South, where there's rain and snow and all that stuff. California, a lot of that is weather driven, as well. But California it's like 75 degrees all year long, pretty much. So, but from that perspective, I think people don't need to realize the timing of the market as well when they're looking at when they're going to be doing these listings and when they're going to be determining like the start date of their renovations and stuff like that too, because you're looking at what the price is going to be when you're exiting the home, not right now, right? So you're looking 3 months, 6 months ahead of time to be able to make sure you know what that price is going to be at that period. So, well,
yeah.
how do people get a hold of you, Gina, if they want to work with you on the high end market or help you on some of your flips?
So I'm on Instagram. It's Gina Tang 28. I'm also on Facebook. It's just Gina Tang, and I'm also on LinkedIn, Gina Tang as well. So, but on Instagram, I'm Gina Tang 28, and I do post about my flips and all the good information. So I really enjoyed being here today, and I hope I shared information with you that that you found was helpful. So
Awesome, no problem. And if anybody needs to get a hold of me, you can go to MathewOwens.com with one T in Matthew. We do have a quick analysis sheet on there if you guys want you can plug in like 5 numbers and understand what your profitability will be on your flip. So hope that helps you guys. And look, thank you so much, Gina. It was really great talking with you about what's happening in the high end market in Southern California and some of these rental issues that come up. It's crazy the knowledge base you get after doing this for this long and being a landlord this long. So really appreciate the insights. Thank you so much. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, You can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.